All right, let's talk about something that affects basically anyone who has ever earned money, found money, or even just been given money. We're talking about gross income. Now, I know, it's the first number on every tax return, but what it actually is, well, it's probably way broader than you think. Let's dive in.
So when you hear the word income, what's the very first thing that pops into your head? For almost all of us, it's that paycheck, right? The money that hits our bank account from our job. It's our salary, our wages, the money we actually work for.
But here's the big question. Is that the whole story? Is your salary the only thing the IRS actually considers to be income? The answer is a huge, resounding no. And honestly, misunderstanding this one simple fact can lead to some major headaches down the road.
So let's get into what the real definition of gross income is. You're about to see just how much bigger this concept is than you might have thought.
Okay, this right here, this is the official language, straight from the horse's mouth, Section 61 of the Internal Revenue Code. The key phrase you've got to lock onto is from whatever source derived. I mean, that wording is so intentionally vague, and it's incredibly sweeping.
So let's translate that legalese into plain English. It really just boils down to this incredibly important rule of thumb. You have to assume everything is income. The starting point is that any money, any economic benefit you receive is taxable. It's only not taxable if Congress has gone out of its way to pass a specific law creating an exception.
So that gives us our working definition right here. Gross income is any economic benefit you get that hasn't been specifically carved out and excluded by law. It's kind of like a guilty until proven innocent system for your money.
Now, to make all of this way easier to wrap your head around, let's break it down into a really simple framework I like to call the 3 layers of income. Here are the 3 layers we're going to walk through. First up, the stuff that's pretty much always taxable, no questions asked. Second, we've got the "it depends" category. And finally, the items that are specifically excluded. So let's start with the most straightforward one. This first layer, this is what most of us already think of when we hear the word income. It's the clear-cut, unambiguous stuff that you just know you're going to pay tax on.
This layer includes all the usual suspects, right? We're talking W-2 wages, income from a side hustle, tips you make, bonuses, interest you earn from a savings account, profits from selling stock, and yeah, even unemployment benefits. This is really the bedrock of gross income.
All right, let's move on to layer 2. Now this is where things get a little more complex. This is the category where you can't just make an assumption. You actually have to stop and do a little bit of analysis.
Here are some perfect examples. Social Security benefits, they might be taxable, but it completely depends on your other income. Scholarships are tax-free for tuition, but if you use that money for room and board, suddenly it's taxable. And with retirement funds, it all hangs on whether you paid tax on that money before it went into the account.
Now, for our third and final layer, the exceptions. Remember that big rule? Everything is taxable unless a specific law says it isn't? Well, this layer, this is that list of exceptions.
The crucial thing to get here is that these items are only considered non-income because there's a specific exception on the books. For instance, that birthday money you got, that's a gift, so it's not income to you. An inheritance or child support, also not income. Congress has made a very deliberate choice to exclude these specific things. So now that we have our 3-layer framework, let's clear up a few of the most common mistakes people make. Because honestly, understanding what isn't income is just as important as knowing what is. Let's look at some key differences here. Selling a stock for a profit creates a capital gain. That is income. But if that same stock just increases in value while you're holding it, that's unrealized appreciation, and it's not income. Yet. Or take a loan. A loan isn't income. Why? Because you have an equal and opposite obligation to pay it back. There's no net increase in your wealth. And this leads to a fantastic rule of thumb. If you're trying to figure out if something is income, just ask yourself this one question. Did my net wealth actually increase? A loan doesn't. A tax refund is just your own money coming back to you. This one question clears up a ton of confusion.
So, we've defined gross income, we've broken it down into 3 layers, and we've cleared up some common mix-ups. But why is getting this one number right so incredibly important? What's the bottom line? Well, your gross income figure is literally the foundation for almost everything else in your financial life. It determines whether you even have to file a tax return at all. It dictates your eligibility for super valuable credits and deductions. If you get this number wrong, everything that's built on top of it could be wrong too.
And here's the real-world consequence. A huge number of those scary letters from the IRS start with one very simple problem. The income on a tax return doesn't match the income the IRS has on file. Getting this right isn't just some academic exercise, it's about staying out of trouble.